Welcome to the deep dive. In the world of semiconductors, there are these giants that often stay out of the direct consumer spotlight, but their impact is absolutely massive.
hmm
Today, we're plunging into the 2024 annual report of one such titan, Semiconductor Manufacturing International Corporation, better known as SES.
Right. SES. They're the leading semiconductor foundry in mainland China and, well, a really significant player globally.
Exactly. Providing that crucial manufacturing backbone on those, 8-inch and 12-inch silicon wafers that power so much of our modern tech.
Exactly. And this report, it gives us a fascinating peek under the hood. Our goal in this deep dive is to really understand the core of SMIC's business.
Right.
Where their revenues come from, how their financial engine performed last year, and what their strategies and the broader landscape suggest for the future.
So kind of extracting the key intel without needing to read the whole thing.
That's the plan. We're trying to pull out the vital intelligence you need to understand this key player.
Okay, so let's get right into the nuts and bolts then. SMIC's business. The report breaks down their wafer sales in a few key ways, and the first thing that jumped out at me was the dominance of those larger 12-inch wafers.
It's a really telling statistic, isn't it? In 2024, 12-inch wafers generated, wow, a whopping 77% of their total wafer sales revenue.
77%, so only 23% from 8-inch.
Just 23% from the 8-inch variety, yeah. And this isn't just a number. It really signals that continued industry-wide march towards more advanced, more efficient manufacturing.
Because the leading edge stuff is usually on the bigger wafers.
That's right. Those leading-edge chips are typically fabbed on these larger wafers, so it kind of underscores SMIC's growing capabilities in, let's say, more sophisticated technologies.
That makes perfect sense. Bigger wafers, more chips per wafer, potentially lower cost per chip for those advanced designs. Okay, so drilling down further, where are these wafers actually being used, the applications?
Right. And the breakdown for 2024 shows a pretty diverse demand landscape. The largest chunks were computer and tablet and consumer electronics,
Both at 27%.
both accounting for 27% of their wafer sales, yeah. Then smartphones were close behind at 25%,
Okay.
followed by connectivity and IoT at 12%, and then industrial and automotive at 9%.
Interesting. That near even split at the top between computer, tablet, and consumer electronics. How does that compare to, say, 2023? Was it the same picture?
Not exactly. There's been a subtle shift, but potentially significant. In 2023, smartphones actually held a slightly larger share,
Oh, okay.
while industrial and automotive were a smaller piece of the pie back then. So this suggests, a dynamic market where demand drivers are evolving.
Right. Maybe the impact of remote work still boosting computers.
Perhaps, yeah. That continued impact of remote work and learning on the computer tablet sector. And maybe this slightly increased share for industrial and automotive could point to growing demand there, even with those cyclical adjustments the report mentions for auto.
That makes you wonder about the strategic implications for SEMIC, doesn't it? Are they actively shifting focus or capacity? Now, let's talk geography. Where are these wafers going? The report seemed pretty clear about a strong domestic market.
Absolutely. China is, well, overwhelmingly their dominant market. In 2024, a massive 80% of their sales were within China.
80%. Wow, that's up from last year too, wasn't it?
It is up from 74% in 2023. So that indicates an even stronger reliance on domestic demand.
And the other regions.
In comparison, sales to America accounted for 16%, which is actually down from 23%.
Okay.
And Eurasia contributed just 4%, which is a slight tick up from 3%.
So it really underscores how crucial the Chinese market is for them right now, and probably their near-term growth too.
Definitely. It also, raises questions about their exposure to domestic economic trends and policies.
It certainly does. So given this strong domestic anchor, what's SMIC's overall growth strategy? What initiatives are they putting in place?
Well, their growth strategy seems to be built on several key pillars. First and foremost is a significant and ongoing commitment to R&D, research and development across a range of technology platforms.
Yep.
The report gives us a snapshot of some specific projects, like their 55mm HV display driver Gen 2, 65mm RF-SOI, 90mm BCD, and also advancements in 8-inch BCD and analog platforms.
Okay, let's break those down a bit. Why are those specific R&D areas important? What markets are they targeting?
Right, these give us some really interesting clues. The 55mm high-voltage display driver tech, for instance, that's likely aimed at the ever-growing market for displays, all sizes.
Smartphones, tablets, monitors, car screens.
Exactly, everything. Then the 65mm RF-SOI, that's radio frequency silicon on insulator, that's crucial for the radio chips.
Like in phones and Wi-Fi?
Precisely. Smartphone front-end modules for cellular and Wi-Fi connectivity. And the BCD platforms, bipolar CMOS demos, those are vital for managing power efficiently in devices.
So power management chips, audio amplifiers.
Audio amplifiers, controlling motors in various things, and increasingly in automotive for power management control systems.
Yeah. So it sounds like a strategic mix, hitting high-volume consumer markets, but also growing specialized areas like auto. Very versatile. What else is part of their growth roadmap beyond just developing new tech?
Operationally, they're laser-focused on continuous improvement,
Meaning?
boosting production line efficiency, ensuring high quality and yield for their wafers, rigorously controlling costs, to stay competitive.
Standard stuff for a foundry, but critical.
Absolutely. Leveraging economies of scale as their volumes increase and speeding up the development cycles for new process tech. They also explicitly mention building strong long-term partnerships.
With the chip designers.
Yeah, with the design houses and also the IDMs, the integrated device manufacturers who design and make their own chips sometimes.
Those partnerships seem absolutely critical in this complex semiconductor world. Okay, so lots of ambition, lots of initiatives, but what about the challenges? What headwinds does SMIC acknowledge?
Well, the report highlights several pretty significant challenges. The first is just, intensifying competition in the foundry space. It's a global market with some very established, very advanced players.
No kidding.
Secondly, they point to the fierce global competition for top-tier technical talent. R&D is the lifeblood, right? So attracting and keeping those experienced engineers and scientists is a constant battle.
Absolutely. Talent is key. What other potential pitfalls are they worried about?
Well, given the sheer cost of building and running these fabs, multi-billion-dollar operations, they highlight the inherent risks of being so capital-intensive.
Like assets losing value.
Exactly. Potential for asset impairment if market prices for chips fall, or if, new tech breakthroughs make their current equipment less cutting edge. They're also exposed to unpredictable exchange rate and interest rate fluctuations, even though they try to manage those risks.
And cybersecurity, I imagine.
Oh, yeah. The ever-present threat of cyber incidents disrupting operations or leading to data breaches, that's a major concern today.
And physical risks, too. Manufacturing hazards.
Right. They also acknowledge the more tangible risks from using hazardous materials in production, potential for fires, explosions, natural disasters, or even disruptions in essential utilities like power and water.
That's a sobering, but yeah, realistic look at the pressures. Okay, let's pivot now to the financials. How did SMIC actually do in 2024? What are the key numbers?
Okay, so on the revenue front, 2024 was a strong year for SMIC. Their total revenue saw a significant jump, 27.0% year-on-year.
27%. To what total?
Reaching US $8,029.9 million. And the revenue specifically from wafer sales grew even faster by 29.2% to US $7,486.9 million.
Okay, and what drove that growth?
What's really driving this top-line growth is a substantial increase in the volume of wafers shipped, up 36.7%. So they're making and selling a lot more physical wafers.
That's impressive volume growth. But I noticed the report also mentioned a decrease in the average selling price per wafer, the ASP. How did that fit in?
You're sharp to catch that. Yes, the ASP did indeed decrease. It went from US $988 per wafer in 2023 down to US $933 in 2024.
Why would that happen? Product mix? Pricing pressure?
It suggests a couple of possibilities, yeah. Either they shifted their product mix towards selling more, let's say, less expensive types of chips, or they faced some pricing pressure in the market, maybe increased competition, or just supply and demand dynamics.
And that lower ASP must have impacted profitability, even with the higher volume.
It partially offset the positive impact of that higher shipment volume on their profitability, exactly.
Right, so more sales, but maybe a slightly lower price tag on average? How did this play out in their overall margins then?
Well, their gross margin, this revenue minus direct production costs, saw a slight dip from 19.3% in 2023 down to 18.0% in 2024.
Okay, a slight dip. What about net margin?
The net margin profit, after all expenses, taxes, etc., that experienced a much more significant decrease. It fell from a pretty healthy 17.8% in 2023. Down to just 9.1% in 2024.
Wow, that's nearly halved. So while core production profitability was kind of stable, other factors really hit the bottom line.
Exactly. That tells us something else squeezed profitability significantly.
What does the report point to?
It does. While that increased wafer shipment was the main revenue engine, the report explicitly points to the lower ASP and the compression of their margins as key reasons for that drop in overall profitability.
Could be higher operating costs, R&D spending.
Could be a variety of factors, yeah. Increased operating expenses, maybe higher R&D spending to fuel that future growth we talked about, or just change in the pricing environment.
Let's look at some other key financial indicators. What about EBITDA and earnings per share?
Okay, EBITDA, earnings before interest, taxes, depreciation, and amortization,
Yeah.
that actually increased in absolute terms. It went up to US $4,379.7 million in 2024 from US $4,064.2 million in 2023.
Okay, so earnings before those items went up, but what about the margin?
Right, the EBITDA margin as a percentage of revenue, that also decreased. It went from a very strong 64.3% in 2023 down to 54.5% in 2024.
So earnings grew, but not as fast as revenue did.
Precisely. And when we look at earnings per share, both basic and diluted figures saw a significant drop, down 45.5% to US $6 in 2024 from US $11 in 2023.
Which lines up with that lower net margin we saw, less profit per share.
Exactly. Less profit to be distributed per share. Outstanding.
So the big financial story, strong top-line growth from volume, but definitely some pressure on profitability. Let's dig into the core statements quickly. Income, balance sheet, cash flow, and any key numbers pop out.
Sure. Looking at the income statement, like we said, revenue US $8,029.9 million, and the net profit for the year US $729.993 million.
Okay, balance sheet, end of 2024.
As of December 31st, 2024, total assets stood at a pretty substantial US $22.5 billion, roughly. Total liabilities were significantly lower at around US $1.9 billion.
So a strong asset base compared to liabilities.
Relatively strong financial position, yes. The report also flags some interesting shifts within the balance sheet, like an increase in financial assets and amortized cost, a decrease in contract liabilities, an increase in current borrowings, stuff that might warrant a closer look for deeper financial analysis.
Right, those movements can give clues about strategy and financial health. What about cash flow? Where did the cash come from and go?
Okay, in 2024, SMIC had generated a healthy amount from operations, about US $4.18 billion in net cash from operating activities, core business cash generation.
Good. But what about investing?
Well, they also had a significant net cash outflow in investing activities, US $4.52 billion going out.
Whoa, more going out investing than coming in from operations. Must be CapEx, right?
Almost certainly. That large outflow is highly likely due to the substantial capital expenditures they're making, expanding production capacity, upgrading tech.
And financing activities. Did they raise cash?
On the financing side, they generated about US $1.61 billion in net cash. Could be from taking on new debt, issuing stock. The report doesn't detail the specifics right there.
Okay. That massive investment, that CapEx, really underlines their growth strategy. And we can kind of figure out their free cash flow from those numbers, right? Operating cash minus CapEx.
Precisely. If you take the net cash from operations and subtract that big outflow from investing activities, it looks like their free cash flow was likely negative in 2024.
Which isn't necessarily bad for a company heavily investing in growth.
Right, not alarming for a high-growth phase requiring big upfront investment, but definitely something investors will watch closely going forward.
Speaking of investors, let's shift to shareholder value. Dividends, share buybacks. What's the plan there, according to the report?
Well, on dividends, the report is very clear. The company did not declare or pay any cash dividends on its ordinary shares in 2024.
And the reason?
Their rationale is tied directly to that growth strategy we just discussed. They state they need to keep sufficient funds to fuel their capacity expansion and core business development.
Reinvesting everything.
Essentially, yes. They even look ahead, saying they expect capital expenditure in 2025 will exceed 30% of their latest audited net assets. That strongly suggests reinvestment is the priority over direct cash returns right now.
Makes sense strategically, given the growth plans. What about share buybacks? Any activity there in 2024?
The report mentions that at their 2024 AGM, shareholders gave the board the okay, a general mandate to repurchase their Hong Kong shares, up to 10% of the issued shares.
So they could buy back shares, did they?
Well, while they got the authorization, the annual report doesn't actually detail any share repurchases being carried out during the 2024 fiscal year. So they had the option, but it seems they didn't use it in that period.
Okay, so no dividends paid, no buybacks executed in 2024. How else is SMIC aiming to deliver shareholder value then?
The report does highlight their stock incentive plans, the 2014 and 2024 equity incentive plans.
For employees.
Yeah, designed to attract, retain, and motivate key talent by offering them share-based compensation. The idea is you align employee interests, including directors and senior management, with the company's long-term success.
And that indirectly drives shareholder value.
Exactly. The report even gives specifics on restricted share units, RSUs, granted to various employee levels.
Got it. So the current approach to shareholder value seems heavily weighted towards reinvestment for growth and using equity to incentivize performance. Okay, looking ahead now. Based on the report and the general context, what's your assessment of SMOK moving forward?
Well, the report itself notes the global semiconductor industry showed signs of recovery in 2024, sort of a moderate upward trend in supply chains.
What's driving that?
They point specifically to strong demand from areas like AI, high-speed computing, and also the ongoing upgrades in intelligent terminal products, phones,
Yeah.
gadgets.
What about automotive?
Interestingly, they mention the automotive electronics market is undergoing a, quote, cyclical adjustment, which could mean both challenges and opportunities for SESMIC in that space.
And how is SMIC positioning itself to ride these trends and navigate any bumps?
Their core strategy seems consistent,
Oh.
solidify their position as a leading global foundry. That means relentlessly pursuing tech advancements, aggressively expanding production capacity.
Which we saw in that huge CapEx number.
Exactly. That huge planned CapEx for 2025 is clear evidence. And also strengthening relationships with customers, those design houses and IDMs. Their success really hinges on executing these priorities in a very competitive world.
So strong revenue growth last year, yes, but the pressure on profitability and the continued high investment levels are definitely things to watch. What's your overall outlook based on this snapshot?
Well, the revenue growth in 24 is definitely positive, but that contraction in profitability margins is something investors will be scrutinizing.
Yeah.
The big planned CapEx for 2025 signals that focus on long-term growth, but it probably means continued pressure on free cash flow in the near term, and no dividends reflects that current priority, reinvesting for future expansion.
So what are the most critical things our listeners should be watching to gauge SUNC's performance and progress in the coming years?
Okay, several factors seem key. First, the success and speed of their R&D. Can they bring new competitive process tech to market effectively?
Right, execution.
Second, how well can they navigate that intense industry competition, both globally and within China? Third, their success in attracting and keeping that top technical talent we talked about. That directly impacts innovation.
Makes sense. What else?
And finally, closely watching the demand trends in their key application markets, smartphones, auto, IoT, computers, and how they perform in their dominant China market versus any international expansion efforts. That will give valuable clues about their growth path and resilience.
Those are all really critical points. Okay, so to quickly recap our deep dive into SMIC's 2024 annual report, we saw a company with significant revenue growth, driven mainly by shipping more wafers.
Right, but profitability took a hit from lower average selling prices and squeezed margins.
And they're clearly in a phase of aggressive reinvestment, pouring money into capacity and tech, shown by the big CapEx plans and no dividends.
And that leads us to a final thought for you, the listener. Considering SMIC's really ambitious investments in R&D and production capacity, what are the potential long-term consequences? For their market standing, sure, but also for their ability to eventually improve profitability.
Especially when you factor in the, let's say, dynamic and complex global semiconductor scene and those geopolitical factors that hover in the background, even if not detailed in the specific report.
Exactly. So what specific metrics and developments should you be tracking in future reports to really assess their progress and see if these strategic bets are paying off? It's definitely a fascinating case study in a truly critical global industry.